Welcome to The Explainer. Today we're diving into a truly fascinating intersection of macroeconomics and agronomy. We're actually cracking open an internal credit committee review that evaluates the credit risk and lending suitability for Pakistan's agriculture sector, specifically looking at the updates for the FY 2026-27 budget. If you've ever wondered how major financial institutions weigh the risks of feeding a nation against the harsh realities of policy and climate, well, you are in exactly the right place. To really grasp the sheer stakes of what we're looking at, let's kick things off right here. Over 37%. That is the portion of Pakistan's entire employment force that relies directly on agriculture. We are not just talking about some small niche corner of the economy. We're talking about the absolute backbone of a nation's livelihood, and roughly 24% of its total GDP. When a sector is this massive, lending to it isn't just a basic financial decision. It's a major, structural, macroeconomic pivot. So here's our roadmap for today. We'll start with Pakistan's agricultural landscape, check out the FY 2026-27 budget boost, assess the financial risks, look at opportunities for sector growth, and finally, we'll get to that final credit verdict. Okay, let's dive straight into part one, Pakistan's agricultural landscape. Now, the target for the FY 2025-26 harvest was originally set at a pretty optimistic 4.5% growth, but the actual result? A somewhat sluggish 2.89%. Honestly, the real story is hidden right under that number. Major, critical crops actually only grew by a tiny 0.65%. You might be wondering why. Well, farmers were absolutely squeezed by sky-high input costs, and that put incredible pressure on yields, keeping wheat production way below its prior peak. In fact, it was the livestock sector that really stepped up as the main anchor to keep the overall growth rate afloat. Moving right along to Section 2, the FY 2026-27 budget boost. So how exactly does a government respond to a highly squeezed harvest with a vital injection of capital? And the sheer scale of these mid-June 2026 budget numbers is just something to behold. The absolute standout here is the Zarkhez scheme, or Digital Zarai Karza. This initiative aims to deploy 300 billion rupees in interest-free, collateral-free loans straight through a tech platform. The goal? To bring 750,000 small farmers right into the formal financial fold. That is an enormous push for digital financial inclusion. Add to that a combined 38.2 billion rupees in fertilizer subsidies to stabilize urea prices, plus a dedicated Kisan package for farm mechanization, and you can really see the strategic levers being pulled here to force modernization. But the domestic budget isn't acting alone. Signed in late June 2026, a €20 million concessional loan from Italy is stepping in to boost high-value, climate-resilient crops. We're talking olives, pistachios, dates, and cherries. This project is set to create 12 model orchards, agro-processing units, and directly benefit over 18,000 individuals. It's a very calculated, smart move to diversify the sector away from basic staples and heavily into high-margin exports. Let's flip the coin now. Section 3, Assessing the Financial Risks. As any farmer or lender will tell you, a good budget doesn't magically stop a bad storm. When we break down the macroeconomic storms outlined in the credit review, three massive threats emerge. First up, climate and weather shocks. Having such a heavy reliance on the monsoon makes cash flow stability incredibly volatile. Second, we have those high input costs we mentioned earlier, specifically DAP and urea fertilizers, alongside really expensive energy, which continue to threaten profit margins. But the third point? This is perhaps the most disruptive from a lending perspective: wheat policy uncertainty. A lack of a stable support price creates this massive policy vacuum. It violently distorts market expectations and, as a result, completely scrambles the cash flows for borrowers. Working capital intensity is extremely high here because buying seasonal inputs create these massive pre-harvest funding gaps. Which brings us to the brighter side in Section 4, Opportunities for Sector Growth. Despite those heavy clouds we just talked about, the government is confidently targeting 3.6% agricultural GDP growth for FY 2026-27. And this brilliantly illustrates the core tension that the credit committee is wrestling with. On the left side, we have those inherent macro vulnerabilities: inflation pass-through, the wheat policy vacuum, and climate exposure. But directly pitted against them on the right is a massive wave of modernizing momentum. We're talking rapid mechanization through duty reliefs, digital credit formalization via the Zarkhez scheme, and a highly lucrative push into high-value crops supported by international climate finance. It is literally a high-stakes tug-of-war between historical volatility and structural modernization. Let's look at how this tension builds into a really practical strategy for lenders. Because obviously, agriculture isn't just a monolith. Lending suitability changes dramatically depending on scale. For small farmers, typically those under 12.5 acres, the approach leans heavily on collateral-light digital loans through Zarkhez, up to 2 million rupees. Step up to medium farmers, and lenders are looking at 5 to 25 million rupee limits, specifically for asset-backed mechanization, like buying a tractor. For agribusinesses and processors, the focus totally shifts to higher limit trade finance. And finally, for large corporate farms, lenders deploy standard corporate criteria, adding in crucial ESG and climate scoring. It's a perfectly structured ladder of risk management. All right, the moment of truth, Section 5, the final credit verdict. We've seen the sluggish past, the ambitious budget, the severe risks, and the clear opportunities. So the crucial point is, what is the definitive analytical guide for risk management going into FY 2026-27? Well, it basically comes down to this snapshot. The overall credit risk is officially assessed as medium, mostly driven by those high input costs and policy uncertainties. However, non-funded facilities, like trade finance for exports, are rated as low to medium risk, making them highly attractive right now. And those growth tailwinds? Officially marked as positive, huge thanks to the Zarkhez scheme and the Italy project. Which brings us to the ultimate takeaway from the committee. The sector is creditworthy on a selective, well-structured basis. Now make no mistake, this is not a green light for reckless lending. The advice is highly strategic. Lenders absolutely must capitalize on the modernization and formalization momentum. They should fund tractors, support digital platforms, and finance high-value exports. But, and this is a big but, they are explicitly warned to heavily restrict or entirely avoid unsecured large exposures to rain-fed monoculture crops like wheat or cotton unless there is absolutely rock-solid diversification or crop insurance in place. It's just an incredible balancing act of risk and reward. The pieces are definitely all in place for a technological and financial revolution out in the fields. But those traditional macroeconomic storms, they haven't disappeared. Which leaves us with this provocative thought to ponder. Will digital formalization and climate-resilient tech outpace the macro storms of inflation and policy vacuums in the years ahead? We will certainly be watching the next monsoon season very closely to find out. Thanks so much for joining me on this deep dive in today's Explainer. Keep learning, keep analyzing, and I'll see you next time.